Big institutional investors have been wooed by private equity for some time. So some of the big endowments, like Harvard and Yale, have been lured into private equity for a while, and that helped private equity leverage up and do a lot of deals. It's going to be tougher for them now with the way interest rates have perked back up. So have we had the peak period of private equity? Is the next phase they're going to have to offload some of these overgeared plays that they've supported? Arguments are that there was pretty easy money when interest rates are virtually nothing, and they didn't actually have to do much to these businesses. This so-called improvement, wasn't much improvement going on at all. I think there has been a big change in capital markets. And you've had an awful lot of companies leaving the stock market, not just in the UK, but in the US has shrunk a lot as well.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris.
Hello, Lee. Good to see you after a frustrating watch of the football, has to be said.
Yeah, I don't mean to be a negative Nancy, but I'm not so confident after watching that.
I think, like some of the companies maybe we're going to discuss or others that we look at, I think there needs to be a wholesale change of strategy. I really do.
Would you go as far as new management?
Perhaps some of the companies as well might need that as well.
Yeah, brilliant. So what have we got today then? We're going to discuss Hargreaves Lansdown. We've got some updates from a couple of IC Ultimate Stocks portfolio, and then on to the AIM and small caps. We've got a new arrival.
Yeah, good news. Interesting one as well.
Yeah, medical technology group AOTI or AOTI.
Yeah, I'm not sure. We better talk to them about that, how we should pronounce it.
I've got some good updates from MP Evans. I'll whiz through these. We've got Tristel, Brickability, Intercede, Tatton Asset Management, Young & Co, and Victoria to finish. So let's start off with Hargreaves Lansdown then. They've backed the 5.4 billion private equity takeover. What's your thoughts on that, Chris?
Yeah, management has. They've supported it, and it's a bit of a sweetener in the deal. They've got until July the 19th to make a firm bid. This is CVC Capital Partners, a big private equity business. And this company, Hargreaves Lansdown, you may think, oh, I'm not interested in it, but this business oversees 150 billion in customer assets, and it has 1 million customers, UK customers. This is a huge presence in the UK market. So even if it sounds rather boring, you should be aware of it. And there's a bit of a sweetener in the deal because the buyer has essentially said that existing shareholders can remain invested in the unlisted vehicle. Now, the founders who still own Messrs. Hargreaves and Lansdown, who still own 26%, could conceivably stay on board, but in the private vehicle, which is quite interesting. So that might encourage them to say, okay, we'll go with this one.
So the board's backing it then. Is that where we're at with it then?
Yes.
The board's backing it. What would be the next steps for this to go through then?
Well, it's got to be a firm offer. At the moment, it's just I'm not sure, an informal, but conceivably at this price, which is a higher price than it was, the board is behind it with this sweetener in place that there can be a carry over if shareholders wish into the private equity-backed vehicle that's buying it. So watch this space, 19th of July.
Does Fundamental own any Hargreaves Lansdown?
We've got a bit on our general accounts, not a lot. It's not a core position. I think we've got it. It's been a bit of an income play. The shares were a pretty good value, and we haven't held it for that long. As I say, not materially.
What would your decision be?
We're a small holder, so relatively insignificant. We can't take private equity stake like that, so we'll be off, unfortunately.
We'll go international now. We'll just quickly touch on some of these here, but electric vehicle startup Fisker has filed for bankruptcy.
Yeah, I just think it's interesting. This is the third one now. You've had Lordstown Motors, that filed before, and a bus manufacturer Arrival, they filed for bankruptcy. And now you have Fisker, and this is the second time round for this Fisker-backed venture, Henrik Fisker. His businesses have gone bust twice. You've had so much money that's poured into these EV companies, and few of them are going to actually make it. And now we've had another one go bust. And it requires so much investment. Even if you outsource everything like this lot did, they effectively outsourced all the manufacture to other people, but even they didn't make it work. And it's a really tough business to develop a car manufacturer. But look out for more EV startups failing. That's what I would say. Who could be next on the slate? Rivian, I understand, has been struggling. That was a pin-up pickup truck maker, but that another US listed one was worth billions and billions of billions, or tens of billions a few months ago. Now it's a fraction of that. So look out for others. It's not an easy space at the moment.
Does that not make what Elon Musk and his team have achieved with Tesla even more
Oh,
impressive?
it's absolutely unbelievable. What has been achieved there is incredible. Love him or hate him or question if what has been achieved at Tesla from startup to where it is now is just fantastic. And look how many of them you see around now, these cars, all over the place.
I'm just circling back to the conversation we had last week about his 46 billion. One of the audience members had posted a comment, and I haven't fact checked this, but he'd said that Tesla as a company has made more employees millionaires through its stock options than any other company.
Yeah, it's good news.
Because we mentioned about sharing it with the with the workers, didn't we? And then he wrote that Tesla has made more millionaires.
Yeah, no, I always understood they were under option, but the level of theirs relative to his, I suspect, would have been fairly different. I'm not saying they should all earn billions, but it's great. It's great news. And that's always the way with US companies. And it's the way with one we're going to mention here, actually, shortly. Well, I expect it is the way with the next one I think we're going to talk about.
Nvidia, one of the ultimate stocks.
Yeah, one of our ultimate stocks, been going great guns. The share price has now, in line with its results, actually, which were fantastic. It's now the world's largest company by market capitalization. Its current value, as we speak, is $3.4 trillion. So that's more now than Microsoft and Apple. This is in less than 2 years. It's gone from a $300 billion company to a $3.4 trillion one. It's just phenomenal. And through that period as well, it's gone through a crypto phase that fell off a cliff. And then it had video gaming where it was benefiting from, which also fell off. And now it's the go-to company for all things AI, chips for AI processing. So it's amazing. Its share price gains at one point, I think a few weeks ago, had single-handedly driven about a third of the 14% year-to-year increase in this S&P 500 index. One company to dominate things like that.
Does anything concern you, though, about such a meteoric rise?
I mean, too fast. I mean, clearly, and everybody's saying that it moves so quickly, but everybody's got sucked into it. All the momentum's behind it. Clearly, its results have been great, but looking further out, there's clearly competition's going to arrive. Its customers will probably be reluctant to pay top price for its chip designs. So they are looking at putting money into designing their own AI chips, the Apples of this world, the Metas and Alphabets. But yeah, there's clearly going to be competition. The laws of economics suggest that when it's such a big growing market, it's going to attract lots of competitors. Whether they'll be able to get up to speed or get up to that kind of speed quickly, who knows? But yeah, they're in a great position, and well done to them. Amazing.
Yeah, absolutely brilliant. 31 years, was it? The company was founded?
Yeah. To build PC graphics card for video gamers.
Yeah, and the next one of the ultimate stocks as well, we mentioned we're going to discuss too, Adobe.
This is a great business. It's a creative and marketing software company that we're all familiar with probably through their very basic Acrobat and PDF that we all use, PDF documents. But this business was founded in 1982 by a couple of guys, and I don't think they're alive any longer, John Warnock and Charles Getch, and they'd established the company after leaving Xerox. Did absolutely brilliant things, and Adobe latest results have been excellent. Revenue is up sort of 10%, and they really established a kind of software to support printers and the design in printing and publishing to make it a lot easier to interchange between designers and the printers. So there's a common platform, and that they've really done phenomenally well. And they've made a big move. Like a lot of businesses, everything's now subscription based. Investors love that because it brings this so-called recurring revenue. You're sucked into all these subscriptions. I don't know about you, but I'm getting fed up with all the subscriptions we've got to pay for everything. And Adobe itself, I remember last year or 2 years ago, I think they ramped the annual subscription to Acrobat. This isn't the free one, Acrobat Reader. This is the subscription one. They ramped it by 30% in 1 year, the subscription price. And you're sucked into that. There wasn't no other source of viable alternative. So good on them, great product. But the US government now actually is suing Adobe, accusing it of violating consumer protection laws with hidden termination fees and a convoluted cancellation process, which I think is interesting and probably apply. I know it applied to Amazon as well. Amazon got hit with a claim as well from the government for similar actions. And this is clearly on their B2B kind of subscription levels as well, not business to consumer. But I think it's interesting. As I say, the era of subscriptions is going from bad to worse, I think, and we're getting all sucked into them, which is frustrating. I don't know what you think about this, but I think it's about time really that somebody's taking a look at it.
Yeah, I totally agree with you that the subscriptions, you're almost going to pay for everything. YouTube now, the experience is horrendous unless you actually pay for the premium. You're just
Mm,
inundated with ads. I also understand the businesses have to make money,
yeah.
but guess how much money do they have to make? But yet we've got shareholders, hungry shareholders that want to see rising profits and rising dividends and all that side of it. So, somebody's going to get squeezed out there. Is it the shareholders that you're not going to get a dividend raise this year? Or is it going to be the consumer on the other side that gets a 30% rise on their Adobe subscription? Or do we tell the shareholders the end of year results that, yeah, we didn't raise subscription prices, so we're just the same as last year? What happens to the share price?
Yeah, they got it. They're answerable to various parties, aren't they? But
Yeah.
I worked out now Adobe, I say over a 5 year time span, based on the subscription, I'm going to be paying £1,000 for this bit. And that was probably for a product you used to buy outright and whose regular updates you didn't really need because it was pretty good. You probably bought it outright for about 300. Now you're paying 1,000 over 5 years and 2,000 over 10 or more, with the ability of the software provider to keep lifting the fees 5% each year. The laws of compounding, it just becomes crazy. But I think, and this point is that I think the Federal Trade Commission, the US, is saying Adobe failed to clearly disclose its terms to its customers. You're faced with pages of terms that you're
It's
supposed to
true. Yeah.
read through. They're just indecipherable. So I think they've got to start being clearer, definitely.
Yeah, 100%. They could certainly streamline that and make that much easier. And if that's what the government are getting involved in, then I definitely back that. I wouldn't want to see the government stepping in and starting to say, shall we say, regulate subscription
No,
prices.
yeah, we are in over-regulated mode, I think,
Yeah,
everywhere, aren't we?
yeah,
Yeah. No, I tend to agree with you. Yeah.
yeah. But yeah, 100% subscription. It's just the consumer is certainly being squeezed at every turn. Rant over, shall we?
Yeah, absolutely. But a great company, great margins, 30+% operating margins, 30% return on capital, growing double-digit growth, putting money into AI. And this business has been a fabulous innovator over the years, and it's been a good acquirer of other innovators. So, look, brilliant business, Adobe, worth looking at. I would implore people to look at it. Great company.
You've just mentioned something there that's just made me think. Do you think AI is a threat to Adobe? I know there's,
Yeah, it is. It is a threat, and it's also could be an opportunity as well if it gets
yeah,
it right.
true.
But people have been considering it, worried about the threat bit more than the opportunity, and that's depressed the shares. But it's so embedded in the designer's world and well liked that it could be tough to unseat. But it tried to buy a business called Figma, which fell through. It got unwound by the competition authorities. I think some people would have been interested. They were paying a huge sum of money for it. Some shareholders were relieved. I think users were a bit disappointed because they could have seen real benefits in this acquisition sort of being integrated with Adobe. But yeah, you're right. AI could be a threat.
Shall we move back to the UK then and Games
Yeah.
Workshop?
Another of our ultimate stocks been doing really well. Games Workshop, creator of fantasy games. Good trading update, trading marginally ahead. It's got loads of licensing revenue set to come through. It's going to be boosted because it's got this deal with Amazon to develop the Warhammer 40,000 universe into films and a TV series. It's going to take a few years to hit our screens, but that's in the planning. But yeah, Games Workshop looks in great spot and trading really well, and clearly has great international growth potential still. It's not just about the UK, but great international growth potential. And so conceivably, if it starts into international markets, the growth potential is huge. Up to now, a lot of it has simply been a bit about the UK market. If this hobbyist gaming thing starts really taking off, think of China. If you could work out there as well, where it started tiptoeing, it could still have a long way to go.
The deal with Amazon as well that was signed in December 2022. It could be really interesting.
Yeah, you can imagine that. It hasn't, a lot of people don't have had exposure yet, and suddenly, boom.
Well, that's it exactly. I do have concerns about Amazon may or may not produce the show, and I think that's key. If they produce the show in line with the brand, then it could explode, and people who may have never heard of Warhammer all of a sudden could become new customers of Games Workshop.
And it is a bit of a win because remember they're getting paid. Rumor has it circa $1 million per TV episode. So
Yeah.
bang, they get the licensing revenue. But it's the
What
conceptually
do they sell on the merchandise?
exactly, and the
Yeah.
perception of them. Suddenly, everybody's becoming aware of it. You could have a craze boost, and this hasn't been a craze business. It could get that boost as well. Great stuff. We like it.
Going to be interesting, definitely. Shall we move on to AIM market now? We've got a new arrival.
Yeah, this is great news.
AOTI or ATOI, however you want to pronounce
Oh,
it.
I don't know. We'll have to ask management on that. But it's a medical technology group with a mission to help people with chronic conditions get back to their lives to the full of. Great. So a great mission statement there. It's founded in 2006, based in Oceanside, California, which sounds a rather nice place to be. I assume it's by the water there. But yeah, I think it's just south of LA, between LA and San Diego. They developed an innovative at-home therapy to deliver oxygen topically into chronic wounds. It's got decent revenues. Revenues last year rose 31% to $43 million. And they say it's profitable at adjusted EBITDA level. I'm not a fan of adjusted
Nope.
EBITDA.
Yeah.
But yeah, it's selling things, apparently making money at the adjusted EBITDA level. There are going to be some costs associated with the IPO. But look, it's just great to see an IPO on AIM. I'm always a bit suspicious of US ones on AIM, I have to admit, because I always question a small US company, why it needs to come to a smaller capital market for money when it's actually existing in the biggest capital market in the world. So if the potential was as big as it's suggesting, why wouldn't it get a hearing in the United States? But look, it says addressable market approximately 12 billion. Great to see a new company on AIM, and something quite nifty as well by the looks of things.
What did it raise? Did it raise 19.5 million
I
on the
think
on?
of new money, yeah. So it raised gross of 19.5, and there was a further 15.6 by selling shareholders. The market capitalization was 140 million on flotation, which is good size. Great.
You've got to question, surely they could have raised 19.5 million on the US stock market, couldn't they? In
Well,
like,
or even off the US stock market, even venture capital, private equity. If it's such a brilliant idea and everything, why has it come to the UK? That is, I'm always suspicious about US listings over here. Just something doesn't generally ring true, and that's often been the case. Some have succeeded, and admittedly, it's too small for the NASDAQ, probably, but yeah, good luck to it. It does have a presence in the UK. It bought a UK business as well. So it does have an operating manufacturing presence in the UK, which is good.
yeah, so perhaps maybe want to do a little bit of digging on before you jump in. But unfortunately, as one arrives, we may well be losing another, and that's Alpha Financial, isn't it?
Yeah, it looks like it. Alpha Financial Markets Consult. It's
Mm.
a specialist consultancy business to the financial services sector, the investment banks, investment managers. Yeah, and it's again looks like it's accepted an offer from private equity. So AIM's and that's an AIM company. So we're going to lose another one, which is frustrating. But what can we do about it? We're not holders, I should add.
In your multi-decade career of investing, in particular around the AIM, have you experienced the amount of companies that AIM is losing to this level before? Because your business, fundamental asset management, is predominantly based on investing in AIM companies for the IHT, isn't it?
It is, yeah.
Is this something that you've experienced before, and does it concern you? Is it a concern?
It's a real concern because we're losing a lot of good companies. The universe of good companies to invest in is shrinking. The real problem is, though, the lack of IPOs. Previously, you used to lose and you had others coming on. So the trough was being refed all the time. We haven't had the IPO bit, and that's been the real problem. It's going to be tough to refill the hopper. But yeah, we're losing some really good businesses. Previously, we lost them because a lot of them are rubbish. They're all failures. Now we've got a lot of good companies that are being taken out far too early. Ironically, looking at results from Alpha Financial today, they weren't actually that great. Profits were falling. Market they're operating is a bit tougher. So you've got a takeover now of business that actually hasn't been trading fantastically. But clearly, you've got a private equity coming in and think about the long term, be happy to hold it and go through the tough times and probably relist it or find something else to bolt it onto and relist on the stock market in 5 years' time.
Why do you think there's not as many IPOs? Is there just not that many companies that are starting up out there? There's not many UK startups, or are they choosing not to list on the
I think a
stock
bit.
market?
I think a bit of both. You've had quite a lot of startups, a lot of EIS funded companies, a lot of early stage. We've got great entrepreneurs in the UK and across Europe as well. There's some great businesses kicking off, but you've got a load of money's gone into private equity. They're awash with money. A lot of venture capital money's in there, so you don't necessarily need to list on a stock market and be exposed to public demands, and you can quietly grow with the help of with private equity's money, which has really stopped many companies wanting to join. It's quiet, probably a quieter life. Still, you've got still got a lot of demanding financier. It's probably easier than having to expose yourself to the rigors of the stock market. But yeah,
How,
look, interest rates as well have impacted where people want to put their money as well.
Has the way that companies acquire funding evolved due to private equity? And has that moved on to a new sort of level or a new paradigm? But the investment community, the way investors invest in companies is not caught up. Does the investment community, in the way it deploys its capital, need to catch up to how companies are now being funded? Or am I off the mark there with that question?
Big institutional investors have been wooed by private equity for some time. So some of the big endowments, like Harvard and Yale, have been lured into private equity for a while, and that helped private equity leverage up and do a lot of deals. It's going to be tougher for them now with the way interest rates are back up. So have we had the peak period of private equity? Is the next phase they're going to have to offload some of these overgeared plays that they've supported? Arguments are that there was pretty easy money when interest rates are virtually nothing, and they didn't actually have to do much to these businesses. This so-called improvement, wasn't much improvement going on at all. I think there has been a big change in capital markets. You've had an awful lot of companies leaving the stock market, not just in the UK, but in the US it's shrunk a lot as well. In the US, it's still multiple size of the UK one. So you have had this shrinkage as well at the time of private equity being very strong.
Could be just a cycle maybe we're going through, as we do go through cycles, as
Yeah.
opposed to a paradigm shift.
It's again all about that interest rate. It's responsible
that's
for
what
so
seems
many ills, so many and goods, but so many ills. When you're paying nothing, virtually nothing for debt, it can create all kinds of problems. And that's what we've had.
I know this is heresy to say this, but in my opinion, house prices are still insanely overpriced because the low interest rates has fueled house prices to an unsustainable level, or in my opinion, unsustainable.
Right. I agree. Yeah, I agree.
But I know that's heresy for a lot of people to hear. But for me, the house prices still need to come down 30, 35, 40% to match a lot of people's income where the UK is actually at. It, as you say, it may have fueled this distortion with private equity and the way companies are now receiving funding as opposed to the traditional route of IPOing.
Yeah, I think you've got a point.
Yeah, who knows?
The point is, it's down to common sense at the end. You see it, you can see it as clearly as anybody else. And you're right.
Yeah.
Things
Anyway,
are unaffordable. Yeah.
Should we come back to the companies now, which is what the audience have come for?
Some may. MP Evans, this company's been around for donkey's years, 100+ years. Producer of, and now importantly, sustainable Indonesian palm oil. Roots in the 1870s. It's going pretty well. It's a constituent of our aim for high yield portfolio. We hold as well fundamental in our high income aim portfolio, and it's doing pretty well. Palm oil prices holding reasonably. Production's going up, and it's got a lot of its own mills as well. And so, yeah, it's in good shape. It's big on sustainability. It's been a long-standing member of the Roundtable of Sustainable Palm Oil. And this is a big thing about palm oil. There are a lot of people have an issue with it, and MPM is doing its best to prove that it's a good producer. You get a lovely dividend yield out of this. It's mostly a dividend play, 5.5% dividend yield, trading at a single-digit multiple. Shares are very cheap. Yeah, it makes decent margins as well when the prices are high. You get a bit of cyclicality clearly when oil prices fall, too much planting, too many crops. But then again, you can get the benefits as well and they rise. So yeah, look, this is a conservatively run business that's doing very nicely.
What's the house broker target for it as well?
This is typical house broker. £13 target. Current price is £8.68. House brokers are always very bullish.
Right.
That's suggesting a lot of upside, and I would say that I haven't seen it'll be hard to see a business like this trading at that level. But people are going to pay up for this business. I don't know. For us, it's more about the yield, and if we can get a little bit of capital growth, fine. But if we're picking up a consistent dividend yield on it, great. Growing dividend, that's the important thing. He's got to be growing that dividend.
Brilliant. We've got two contrasting companies here. So Tristel, we've got the director, Paul Swinney, the outgoing CEO, who's selling his shares. And then we're going to touch on Brickability, aren't we?
Yeah, briefly. Tristel, I'm not sure how you pronounce it. We've actually held the shares for a while, but on our AIM book, big position. We've been pretty patient. It's very highly rated. It's a manufacturer of infection prevention products. Got our license in the US now, and people are expecting great things of it, great growth. As I say, shares are expensive. But Mr. Swinney's co-founded the business. I've never seen a co-founder be such a consistent seller of shares. This guy has never wanted to hold many shares in it. He's constantly selling down. Not just now he's leaving, but he's been selling down for, 20 years or however long it's been on AIM. It's been crazy. Often at prices significantly lower than the company's pies. If he'd have kept his stake, he'd be an incredibly wealthy man.
That's
but he's never
interesting. Yeah.
held his corner. Clearly, he's got reasons to do that. And now he holds just 0.33% of the share capital. I think the irony here is director selling is normally a guy that things are going badly. If with this thing, it's almost been the opposite. Mr. Swinney's selling has subsequently in the shares moved to another leg. Maybe selling has encouraged institutions to come in and they're keen to be keen buyers of this stock. But yeah, it's been a lovely business. Been doing great things. So good luck to Mr. Swinney, his retirement, and he's done a great job with it. But
Yeah.
bizarre that he holds such a small stake.
And Brickability, Douglas Price, he's the absolute opposite, isn't he?
This is really unusual. I mean, he sold his business. He was a big shareholder in a company that Brickability bought, a business called Topec, a cladding business. Since he sold, the Brickability shares have fallen. Anyway, he hasn't lost an opportunity to buy them. And he's bought loads of shares. He's bought recently another 400,000 at 67 pence. And he made purchases early in the year at prices as high as it was 71 pence. And he's got now 1.2 million shares. So this guy spent a lot of money on buying stock in a company that's just bought his former business. We was a shareholder in it. So hopefully that's a good indicator for Brickability, which is in the construction materials sector, which has been on its lows, but could rebound really strongly. Really important to be in that, be exposed to that sector, we believe.
Does Fundamental own Brickability?
We do indeed, yeah. We got a nice stake across our AIM book. You get a nice dividend as well. Bit worried that the dividend, they're a bit eager to pay the dividend, but yeah, Mr. Bryce is picking up a nice divvy for all his shares. And I think, when the market turns, interest rates fall, construction sector gets a bit of a encouragement. We can see, we can see it doing nicely, Brickability.
And yeah, of course, and it's always important to do your own research. It goes without saying. But if you did want to read the many detailed articles and the many detailed reports on Brickability and the many other companies that we mention on here, please visit investorschampion.com, where you'll find detailed articles on Intercede, who have just reported excellent results.
Yeah, stunning results. Cybersecurity software company, and it's really doing well. It's got contracts with a lot of US federal agencies, so clearly it has some pretty special software offering that's incredibly secure, and it's really flying. Revenue up 65%. Massive gross margin clearly indicates the technology is pretty good and well invested. Pre-tax profit was up 800% to 5.6 million as well. So it's still quite a small business. Saw its largest order from a US federal agency this year. The forecasts out at the moment are actually for now revenue to fall for the following year. So it's clearly got a tough job keeping this going, but it's been a while coming and always promised a lot, and now it's seemingly being realized. So good on Intercede. So it shows you what excitement you can find on AIM. Great stuff.
So the shares trading at 28 times forecast, is that an issue for you? Or
I think given the momentum behind its order book, I think those are conservative, the forecasts. I would expect this thing to have upgrades. Clearly it's got a wind in its sails now. Been a lot of stuff coming through. I would expect to see some more order boost things. And it's got a lot of cash as well on its balance sheet. It's received cash well up in advance, so it's cashed up. Typically, nobody follows the stock other than the house brokers putting out forecasts. They'll always err on the conservative side. You often see upgrades coming through for a business like this. Yeah, good stuff.
It's quite a bit different being able to serve these types of contracts as opposed to, say, a manufacturing plant. Being able to upscale manufacturing compared to this, that's totally different, isn't it? These can...
Oh, the operational leverage, especially when you're seeing a 97% gross margin. I mean, it's fabulous, isn't it? As you say, you can really press the accelerator here.
It's much easier to press the accelerator, isn't it?
Yeah, absolutely.
Perfect. Shall we move on to Tatton Asset Management then? This is another company that you've highlighted that seems to be doing quite well.
This business is just doing so well. It's an investment management and IFA support services group. And it's interesting. It only deals through IFAs, and all its assets that it manages are all what's called in these IFA wrap platforms. So that means it doesn't have to invest anything in its own technology, or limited amounts, shall we say. It's rely on the technology of the platforms, the likes of Nucleus, Transact, Fidelity. They've all got these big platforms that IFAs love, independent financial advisors really. And Tatton's just contrary to the sector. The sector's been in a horrible state. Tatton keeps going from strength to strength. 27% increase in assets under management and so-called influence to 17.6 billion. It's got to that target ahead of time. And now it's set a new growth target for 30 billion of assets under management by 2029. Great margins, the founders still involved in it. The rating looks really rich. It looks quite highly rated compared to, say, an AIM peer is called Brooks Macdonald, which also has this model portfolio service. Brooks Macdonald is struggling to grow, whereas Tatton just keeps on adding to the pile. And so it's worth a premium. Whether it's worth the current premium, I'm not so sure. Where Brooks got other things up its sleeve, but yeah, Tatton's been doing really well.
Yeah, I recognise time is short, so we'll just move on to Young & Co as well.
Yeah, very briefly, Pub Group Young & Co, big acquisition this year. I just think what's important about Young & Co, I think I've mentioned it before on here. So people are interested in this stock, and it's a nice solid pub group, loads of asset backing, got 288 pubs now after it bought the City Pub Group, not the Capital, but the City Pub Group. But yeah, always beware of the shares. You can buy non-voting shares or voting shares. They're both entitled to the same dividend, and bizarrely, the non-voting shares share price is 36% less than the voting ones. You get a much bigger dividend yield if you buy the non-voting ones. And unless you want to vote, it's not really going to add much as a minority shareholder. I would implore you to look at the non-voting. But yeah, it seems to be doing well. And Young & Co is still family controlled as well.
And then finally, just to wrap up, Victoria, the polar opposite, really, of the previous two we've discussed.
I think Victoria is a carpet and flooring manufacturer. It is looking in a very perilous state. The thing I don't like about this one as well, we've never held the shares, is the fact that its accounts are always flatter, shall we say. A lot of smoke and mirrors. They're never very clear. Their definition for free cash flow, for example, is vastly different to ours. And really, if you look at its debt now, its real debt is over, if you include lease debt and what it owes on its preference equities, over $1 billion, which is staggering for a company like this. And can it recover? I don't know. It's got a tough job trading itself out of this situation if markets stay choppy. Hopefully it can, but it's going to be a tough one.
Just quickly, for comparison, for those that are kind of interested or a bit newer to the world of investing, could you compare a good set of accounts that somebody could read? So they could read, say, Victoria accounts, and then they could read a comparison, a really good set, then just to get that contrast so that in future, when you read good, bad, whatever, they've kind of had this experience of reading two very contrasting sets.
From my perspective, I don't like too many adjustments. I know companies that acquire other businesses, there's an adjustment of amortization, which is an accounting creation, but I still don't like adjustments. I like companies to be honest, straightforward. I like the report and accounts to be timely as well, so I like them to get them out quickly. There's a very small company on AIM, for example, a good Quartix, a telematics business. It gets its accounts out very quickly. There are others as well. James House is another one, which are very clean, generally. James Latham, the timber distributor, very clean accounts, no adjustments, tell it as it is. They don't generally try and hide anything. They're very honest and open. There aren't excuses all the time. If you see accounts, there are lots of excuses in the narrative. That to me is a red flag. I also like people to be honest about free cash flow. And free cash flow for me deduct all the cash payments and taxes in that. You generally have to pay it. Lease payments you generally have to pay. A lot of people try and massage the free cash flow and tell us what it is, which is nearly always pretty different to our calculation of them. I know there are different definitions of free cash flow around them. For example, growth capital expenditure and maintenance capital expenditure. I don't mind companies telling us that, but I like them to explain it properly as well and not give lots of excuses for everything.
You just recommended a company there that's a good set of accounts to read in James Halstead, but it's also a flooring company. So they could actually compare two flooring companies and two sets of accounts.
They could. One has not made an acquisition of only made a tiny one, living memory. That's James Halstead. Whereas Victoria is very much a creation. It was at its heart, it was originally a carpet business of loads and loads of acquisitions and subsequent loads and loads of tidying up, restructuring, all supported by debt. Halstead did not have any debt and is very prudent and conservative, maybe overly so, should we say. But you've got absolute two polar opposites in those two.
Acquisitions fueled by low interest rates, perhaps.
Which have suddenly gone like this. The interest bill on this business of Victoria is horrendous.
And on that bombshell, can we leave it there?
Yeah, I think we should.
Brilliant. Thanks, Chris.
Thanks, Lee. Excellent.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.